I am Guenther, and I work with the Farm Service Agency. And with me is Schweinler. We both work over at the USDA office. Farm Service Agency, a lot of you are familiar with. A lot of you probably aren't familiar with what Kurt and I do in the loan side. A lot of you are probably familiar with where you draw your payments, CRP, like last year, Livestock forage program, lots of money went out the door because of that. But we work on the loan side. And what I'm going to do is spend a little bit of time going over with you. There's some handouts that we gave to each of you, and go down through these and explain. And if you have any questions as we're going through this, please feel free to stop and interrupt me at any point. But first, before I get started, a little humor before I get started. Probably a lot of you have gardens, right? See, show of hands. Sure. I just want you to know that you need to be careful when you're out in your gardens this time of year, because the corn have ears, the potatoes have eyes, and the beans stalk. So just be careful when you're out there. Okay. Little corn humor there. I have one down there that won't say. The first handout that I'm going to go over is this one that has a lot of numbers on it. It's titled Farm Loan Informational Sheet. And what we do, we finance operations that cannot get credit from other credit sources. Okay? That doesn't necessarily mean that you're a bad customer, that you have bad credit. In a lot of instances, it means that maybe you don't have the financial ability to put however much money down. The lender down the street or Farm Credit Services requires that you put down to purchase a farm or to get involved in a farming operation. Within the programs that we work with, we have a direct program and we have a guaranteed program. The direct program are the ones where you come in and you apply at the Farm Service Agency. If we approve a loan, the loan funds come from the United States Treasury, and when that loan is closed and you make payments, the payments come back to the Farm Service Agency. Guaranteed program is ones where we work with private lenders, maybe your downtown bank, Farm Credit Services. We work jointly with those other lenders in many instances where they provide part of the financing and we do part of the financing. It's a very good working relationship that we have with many of these other lenders. This sheet I want you to keep and use as a guide for the information that's on here. The first part of it is on the direct program, talks about maximum loan limits. The maximum loan limit on the very first line here, direct farm ownership, that's the loans that we provide financing for purchase of real estate. And as you can see, the maximum that we can finance is $300,000. Rates and terms, they haven't fluctuated much lately, but we can go up to 40 years. Our current interest rate in that program is 3.75%. Okay? All of the rates that I'm going to talk to you about today on the direct program are fixed interest rates. And what I would tell you in today's environment, if you're out there trying to purchase something and you're doing it with borrowed funds, do everything you can do to fix your interest rates, because it's just a matter of time. Our rates are not going to be here forever. Okay? But under that program, we can provide financing for, most of the time what we do is the purchase of land. We can use it for other things like paying part of your conservation practices and things like that. The program right underneath it, Direct Farm Ownership Participation Program, the limit there is also $300,000. And that program, that's where we're going to work with another lender who's going to provide 50% of the financing and we do 50%. Okay? So if the limitation on the direct, on the one up above is $300,000, that's all we can do in that program. If it's going to cost more than $300,000 and you have the ability to get financing from another lender, then obviously we can exceed that $300,000 $300,000 with what that other lender participates. That makes sense? Okay. And back under that participation program, their interest rate on that program is 2.5%, fixed rate. And we're going to do half of it, and the other lender's going to do half. So for instance, let's say $300,000 purchase. We're going to do $150,000 of that program at a 2.5% rate, and then we're going to work with the other lender, and the interest rate and terms are negotiable between you and that other lender. We don't get involved in stipulating rates and terms with that lender in that case. Okay? The purposes of that program on the real estate is the same all across the board. Most of the time it's for the purchase of real estate. Okay? The program underneath there, the down payment program, that's the one that we've had most interest in lately. A lot of them refer to it as the young farmer program. It really has nothing to do with age. It's more an individual that has not farmed, that has been involved in the management of an operation for a minimum of 3 years, but not more than 10. Okay? So by definition, beginning farmer, for FSA purposes, you had to have been involved in management of an operation for a minimum of 3 years, but not more than 10. Okay? Under that program, the individual is going to put 5% down for the purchase price. FSA is going to finance 45% at a 1.5% interest rate for 20 years. The other lender is going to finance the other remaining 50%. This is where the government requires that we stipulate the terms. They have to do it for a minimum of 30 years. They can balloon it at 20, but they have to amortize the payments for 30 years. We can, if the lender requires some additional collateral, some additional consideration, we can guarantee the bank's portion of their 50%. Then we also have an operating loan program that has a $300,000 limit. That interest rate currently is 2.5%. And the repayment terms are based on what we're financing. So if it's crops, we're going to expect repayment at the end of that crop production cycle. If it's breeding livestock, machinery, then we can go up from 1 to 7 years. And in that program, it's going to be anything from your crop inputs, chemicals, seed, fertilizer, things along that sort, to equipment, breeding livestock. And then kind of a new program is really it's still part of the operating loan program, but it's got a different twist to it. And that's what Kurt's going to explain in a little bit, is the microloan program. And I'm not going to get into that because he's going to talk about that. But for the most part, that program is the same as the direct operating loan program with some ease of the application process. We have an emergency loan program that we don't use very much anymore. Let's say you had some kind of natural disaster and you can't get credit from other credit sources. Because of that disaster, we can finance putting you back into the financial shape that you were in prior to that, with refinancing of some existing debts and things like that, with a 3 3/4% interest rate loan. Okay? So that's the direct program. Now, switch gears a little bit, and we're going to talk about guaranteed program. The purposes of the guaranteed program are much like the direct program, but the main difference is you're working with another lender. You work through them in their application process. That lender comes to FSA as the applicant. And they're asking FSA for a guarantee of up to 90 to 95%. And as you can see from the sheet, the loan limitations are much higher, $1,392,000. Again, it's the same for real estate, operating, conservation, and then the contract guarantee is $500,000. But under that program, you're working with your lender that you customarily work with, and you negotiate rates and terms with them, and we don't get involved in that. We talked about the definition that you've got to be involved in operation, management of an operation for a minimum of 3 years, but not more than 10. Well, another part of the definition is that you cannot own more than 30% of the average farm size in the county where you're buying land. Okay? So, and I have the sheet with me. For instance, Lyon County, if you own 169.5 acres, then you would not be eligible for the beginning farmer program. If it's less than that, then you're eligible. And that's not with the ground that you're buying. It's at that point that your application is filed. Morris County, 257.1. Wabunsee County, 192.6. Woodson County, 280.5. Congress, when they budget money for the Farm Service Agency programs, recognize that we have had groups in the past that we're today referring to as underserved groups. So they would put money into those, what they call cohorts. It's just a grouping of funds. And money would be set aside for those individuals that belong in those underserved groups. Women, blacks, Hispanics, Asian, Pacific Islanders. I think that's most of them. Native Americans, yes.
Eskimos.
So if you're involved in one of those underserved groups, when we were short of funds, it made a huge difference in your loan being funded. Today, we're blessed to have plenty of funding. All of our loans are funded. All of our backlog of loans have been funded. So we're in good shape with funding. And so that's not so much a criteria. We have a lot of individuals that have read online the information that's available through the internet and come in and they talk about, well, I get better rates and terms. No, actually, the interest rates and the terms are exactly the same. It's just where the funding is located in that cohort. And then I'm going to go through this other one that talks about loans to beginning farmers and ranchers, and I've covered a lot of it already. For eligibility purposes, there's a lot of criteria. Obviously, you have to be a citizen, legal age. In Kansas, that's 18. You have to substantially participate in the management of that operation. And what we look at that, initially we look at part of your application, we're going to get 3 years worth of tax returns. We have a lot of applicants that come to us and they don't have tax returns to substantiate their management ability. They can supplement that with the form of a narrative, a loan narrative. We made a number of loans to individuals that have not had tax returns filed on themselves. We have a lot of individuals that come to us and they say, well, I've been involved with mom and dad. I haven't filed a tax return myself, but I've done things like determining how much fertilizer to put on, when to harvest the crops, how the livestock are going to be cared for, what herd health program. They've been hands-on as far as the management of that operation, and they can substitute not having filed a tax return with the narrative to substantiate their management ability. Again, beginning farmer program, the loan limitation on that is $300,000. You put 5% down. We're going to finance 45% and a 1.5% rate for 20 years. 1.5% fixed rate. Okay, you're going to work with another lender. You're going to apply through that other lender for the remaining 50%, and you're going to sit down across the table and work with them as far as the rates and terms. The term has to be at least 30 years, but the interest rate is whatever you can negotiate with that lender. In consideration for what that lender is doing 30 years, they're financing half of that loan, but we're going to let them get first lien on the entire farm. Okay? So, in consideration of them doing part of the loan, they get the entire collateral for 50% of the loan. So their risk is basically nothing. They can come to FSA on their 50% and ask for that to be guaranteed.
And then there's a 1.5% charge for that.
Not for beginning farmers.
Oh.
For beginning farmers, it's waived. Okay? So there's a lot of incentives there for beginning farmer loans.
It'd be 95% guaranteed too.
Yes, that's right. And actually, if the bank is persistent that they want to guarantee for beginning farmers, we can actually raise up the guaranteed percentage to 95%. So their risk is like nothing. So, I mean, we've had some individuals where we've worked with lenders before and said, you know, look, we're willing to even give you a guarantee on this, and they're still reluctant. So, well, that opens up the door, and then we'll come back in here, and if we can keep it under $300,000, then they can get the entire financing through us. Okay? Under the direct operating loan program, we do have a rural youth loan program. Any of you familiar with that? So, as long as you're involved, in order to be eligible for that program, you have to be at least 10 years old, not more than 21. Your project would be overseen by a 4-H agent, FFA advisor, something along that line, and we can make loans of up to $5,000 without a cosigner for any kind of operating loan project agriculture related. So if somebody wants to get started a cow-calf operation, which today is not going to buy very many cows and calves, but swine operation, they want to start a vegetable garden, something along that line, then they can apply through FSA under the Rural Youth Loan Program. So I kind of backtracked a little bit, but kind of point that out. So even if you're not here interested in what we're doing, if you know somebody that might be able to benefit from what we're doing with the FSA loan programs, that's youth, and you know that they want to get involved in some kind of agricultural product, help us get that information out to them. Pretty much I've talked about the bulk of what is available for beginning farmers. Again, it's not an issue of age. It's more of how many years you've been involved in the management of a farming operation and acreage, the size that you presently own. Okay, you can be 60 years old and be a beginning farmer. It doesn't matter. Age is not a factor. Okay? Joint financing arrangement, we kind of talked about that, but that's where we loan up to 50% and another lender does 50%, and that's at a 2.5% interest rate. Under that program, we're going to amortize the payments for that over a 4-year time frame.
So I probably won't get through everything I've got here, but you should have a handout for the microloan program. I don't know if I had enough for everybody, and I might have gave too many to some tables, so if you got too many, you might give one back. I was telling Eric we should have a slideshow too. You know, we really don't have one. We got some extras, so that's good. So if you don't have one, there's some in the back. We don't have a slide. Well, I want to point something out on that sheet for microloans. Down at the second column down towards the bottom, it says annual operating loans be secured by a first lien on farm property. That's kind of deceiving. It makes it sound like we want to lien on your land. No, it should say on any farm property. Okay, and it says that again at the top of the third paragraph. It says operating expenses must be secured by first lien on a farm property. No, don't want you to think we're going to take a lien on your real estate. That's on these microloans. That's kind of the last thing we want is real estate security. All right. We don't have a slideshow, but I thought of a demonstration for this, at least for this microloan part, because I brought one with me. I brought a microloan application, and I brought what is typically our regular application. There's our regular application, and there's our microloan application. 33 pages and 8 pages. It's a lot different. Because it's a smaller loan. It's a maximum of $50,000. That's the most that loan can be for. Which, you know, for small operations, that's usually plenty, you know. So let me run through real quick what's in the application and what the differences might be. Okay, both of them have an application there. Ours is kind of one that direct loan application has a lot of other forms in it that you have to fill out. For example, I'm not even going to talk about entities. That's a whole other can of worms. I won't bring that up. Description of farm training experience. There's an area about this big on that microloan application where you can write that in. I would suggest maybe using another piece of That's all you need. On a regular application, you know, we actually want a narrative from you, a regular, you know, and we ask maybe 6 or 7 key things that we want you to expand on. So, 3 years of financial records. Eric talked about tax returns or something like that. Microloans, we don't require that. You don't have to have 3 years of financial records. 3 years of production records. We don't require that either for a microloan. Documentation that the applicant is unable to secure commercial credit. It's the same for both. We don't really require documentation other than your balance sheet is basically what our documentation is going to be. We do have some environmental compliance things. We're part of USDA, we're part of FSA. You know, to be eligible for a loan, you also have to be in compliance environmentally. You know, so you can't have high erodible or wetlands problems. Verification of non-farm income. If you get a direct loan, a regular loan, we have to verify your non-farm income. We don't for a microloan. You tell us what it is, but we don't have to send out a form to your employer or anything like that. Current financial statement. It's part of the microloan application itself, pretty brief. A direct loan, it's a big long balance sheet, you know, it's pretty detailed. Farm operating plan, also regular loan, pretty detailed operating plan. Microloan, not so much. I'm hurrying through this because it's already afternoon. Property owned and leased. You know, you'll tell us if you own and lease land, but we don't need to you know, verify it like we do. Credit report. There is a credit report for both direct and microloans. And then for direct regular loans, we verify all your debts over $1,000. We don't do that with a microloan. Like I said, $50,000 is the maximum for a microloan, and all they're good for is operating. Annual operating or term operating. So you can use it for crop production, buying calves, or you can use it to buy cows, machinery, equipment, so forth. And I'll just point this out. Our regulations require, you know, what's considered a farm. They came out with this here recently. They said that any operation with gross sales of agricultural products at least $1,000 a year can be recognized as a farm. So you can see that's pretty small. It can be a pretty small farm. Eligibility. Eric touched on eligibility. You have to be eligible for our loans. And eligibility for the microloans a little different than our regular loans. Of course, you still have to be legal capacity. You have to be old enough. Of course, you have to be sane enough to get a loan. We always get your driver's license so we know how old you are. And typically when we talk to you, we'll realize if you're sane enough or not. Although I've been fooled. Citizenship or legal alien. That goes, that's pretty self-explanatory. Satisfactory credit history. We expect you to have a satisfactory credit history. And we do get a credit report, and we do look at that. And we understand there's always mitigating circumstances sometimes. No losses to the government. That's the same with the microloan or any of our direct loans. If there's been a loss to the government through some government program, you're not eligible for an FSA loan. I should say that you still could be eligible for the annual operating loan. We do have some leeway there where you can still get an annual operating loan even if you had a loss. The credit elsewhere thing, we've talked about that already. Delinquent federal debts other than taxes would make you ineligible. Federal crop insurance violations, not sure what those are, but I guess it can happen. And then the managerial ability, that's the main thing. You know, Eric talked about 3 years of operating a farm, or the microloans, we don't expect quite that much experience. Some of you may have actually operated a farm, and that's fine. You can write that up in your application. Let me just read this since I don't have a slide. This is what I'm talking about, alternatives for microloans. Microloan applicants also may demonstrate management ability by one of the following. You might have certification of past participation with an agriculture-related organization, such as, but not limited to, 4-H clubs, FSA, beginning farmers and rancher development programs, a community-based organization that demonstrates experience in related enterprises for self-directed apprenticeship, combined with either prior sufficient working on a farm or significant small business management experience. As a condition of receiving the loan, the self-directed apprenticeship requires that the applicant receives, and applies guidance from a qualified person during the first cycle of production and marketing typical for the applicant's operation, and agrees to form a development partnership with the applicant to share knowledge, skills, information, and perspectives. Okay. So you find someone that has got a similar business to yours, and you form some kind of a apprenticeship program or a partnership with them. And basically, you're just going to describe that to us, and that's what we'll use. Okay. Borrower training. Did you talk about borrower training? Okay. If we make a loan, whether it's a microloan or one of our direct loans, we would expect you to take a borrower training course within the first 2 years of you having that loan, unless you've already got, say, a degree in agriculture, or you have some kind of formal agriculture training. The borrower training course is not like a semester, it's usually like a weekend. In fact, there's one program, I believe, out of Indiana that they send you a workbook and some CDs, and you fill out the workbook, and you send it back, and you get certified. So it's not a big deal, but it is one of the requirements for FSA loans. And of course, you have to be the operator of the farm. You have to actually provide the management and the labor for your farm to be eligible. Entity compositions, yeah. Partnerships, LLCs, corporations, they're all eligible. The only one that's not eligible, the only organization that's not eligible is a nonprofit organization. We can't make loans to nonprofits. There are term limits for, and you might help me with this, Eric, there's term limits for direct loans. You can't have operating loans for more than 7 different years, but does a microloan count as one of those?
No, I don't think it does.
Okay, so if you get a regular operating loan in 2015, you used up a year of eligibility, you have 6 left. Now, if you get a microloan, apparently that doesn't use up one of your years of eligibility. And 50,000 is the limit, so let's say you already have a loan from us for $25,000. You're still eligible for a microloan up to $25,000, but after that, you're not eligible. All right. Feasibility. I'll run through that real quick. Your loan has to be feasible. And these microloans, it's going to be a little bit difficult because we're talking about things that aren't real mainstream agriculture sometimes. When you talk about gardens for farmers market, you know, how do we figure yield? How do we figure what you're going to make off of this thing? When we do direct loans, you know, corn, wheat, milo, we have a price that we use for crops in your cash flow. And we can look up what the county average is for corn, beans, wheat in Lyon County or Chase County, whatever. Or we can use your history. If you're a new operation and you're going to raise hairless Russian goats or something like that, we really don't have a lot of information on that. And so that becomes kind of a problem. But I did, and I'll put them back there on that back desk. I printed off a whole bunch of websites that you can go to that give you pricings for different crops and operations and yields and things like that that could help you put together your farm plan and develop that income that shows you're going to have repayment for this loan. Okay. Expenses the same way. You know, we need to come up with some reasonable costs for this operation. And depending on the operation, it could be real simple because we do a lot of it. Other operations, we might not have a clue what it's going to cost to raise pickles. I know we don't raise pickles, but. Okay, and of course, every loan's got to be secured. You've got to have collateral for it. Microloans, it's a little less stringent than our direct loan program. For the annual operating loans, we need 100% collateral margin. And we want 150% if it's available. So if you want a loan to plant corn, we'll take that corn crop as 100%, and then if you got a tractor, we want to lien on the tractor too, if it's possible. For direct loans, if you're buying cows or machinery equipment, all we need is a lien on that. Say you're buying a tractor with a microloan, we'll take a lien on the tractor if it's worth what you paid for it anyway. We try to avoid taking a lien on real estate, but we can use a microloan to refinance other debt. Say you got some debt at the bank, you don't really have you're having trouble making those payments, we can refinance and give you that 2.5% interest rate, give you a 7-year term, but you may not have enough equipment to secure it. Well, then we'll have to take a lien